Good morning, everyone. I'm back again. Today, I want to give a brief on the topic inducement and liquidity. I've already taught you guys about structures and the market structures. So today, I want to touch on the topic of inducement and liquidity. Basically, inducement is like I take my inducement as the first pullback after a market structure shift, or the first pullback before a market structure shift, but basically the first pullback after a market structure shift. There are those like trap areas, the areas that market uses as trap before actually getting to the main point of interest. So I combine my liquidity with other blocks or point of interest. So liquidity actually pulls back or pulls down close to those points of interest, but they do not actually touch it. They just keep building traps around it, making people feel like this is the zone that the market is going to take as the point of interest, and then eventually when they have built up enough liquidity, they sweep that zone, trigger the point of interest, and then start moving in the opposite direction that they intended to move the graph. So I want to give a visual example. This is NZD-JPY. So if you would notice what happened here, price broke out of this consolidation of this ranging market. It broke out, pulled back here. This pullback is what I consider my inducement, because now most people will consider this as a support zone, so they will be taking their entries off the bounce of this inducement. Like for example, when price came here, it bought. When it came to that zone, it bought, and then anyone that buys, they'll probably keep their stop loss below here, I would say. So this is they are accumulating liquidity. The one that buys, they will keep their stop losses. They are accumulating liquidity. This is an inducement. They are accumulating liquidity, but this is basically like a trap. They are creating traps for people, because maybe someone is buying here and expecting to take profit up here, and the price will just keep consolidating, bouncing off of that zone, and you understand what I mean. It's going to come to that inducement area, bounce off, and most traders are going to assume that is the zone the market is going to tap in and continue buying. So most people may be getting in at this support zone, is it in here, getting in here, is it in here. Then what happens? They may decide, okay, price is coming down again, let me wait for price to come to this same zone again. So they will place their buy here, and what happens? Price will come in, take them out, hit their stop loss, and then still reverse and continue buying. This was not this was price finally sweeping that area of liquidity, or sweeping that inducement area, to trigger the main point of interest that happens to be this other block here. So this is the before of this trade, because I had this analysis, which is this. As you can see, when price broke out and created an inducement, I didn't enter off of this the inducement zone, because I knew that was a trap. I had to mark out the point of interest. I triggered the shift of that market structure, and I marked out my liquidity area, which I knew that price was eventually going to sweep, and then trigger the main entry for me to take my buys. So that's just it. So we focus on inducement. Inducement is basically like a trap zone. People is basically like a trap zone, and your stop loss at those obvious level, and your liquidity at those obvious stops that price is going to collect to fuel the market to move in the direction it's intended to move in. So that's why some people get issues and be like, oh, market took me out and still continue going my direction. It's not because of this, it's because you are used as liquidity. So you need to make sure you see liquidity before entering a market. You have to make sure you see where the liquidity lays before you enter a trade. If not, you'll be taken out and used as liquidity. Same with this Euro JPY trade. Euro DTP. Let me use 2 hours. Yeah. So price broke broke structure to the downside, pulled back. This is my inducement, and that is what I use as my liquidity. Now, most people will be taking their sells from this zone. If price comes here, they will sell. Price comes here, they will sell. But this is basically a trap. Market is trapping people, trapping sellers here. So if that market should come back, sweep those liquidity, it's going to take out their stop losses and use it as liquidity to fuel the market to now go in its intended direction. So because I'm familiar with the liquidity concepts, I had to mark out my inducement area, my liquidity area, and wait for price to sweep it. After price has swept it, then I will get in with the other block that triggered the shift of market structure. So it's always nice to mark out your liquidity zones, or you will be used as liquidity. Either you mark out liquidity zones or you will be used as liquidity. That's where you see people saying, oh, my analysis was correct. I would try to sell, price came, they took me out, and then eventually sold. You are used as liquidity. That's just simple explanation. So you have to learn about inducements and liquidity. It is very important if you want to survive in the forex market. I'm not saying everybody has to. There are some people that trade other concepts that they are making money, but with the kind of strategy I trade, I always mark out my liquidity zones because it's very important for me, so I can make sure I'm getting into the exact reversing point of the market. So once you mark out your liquidity, I told you the inducement to me is the first pullback after a market structure shifts. Market shifted structure here, and then it pull back here. So I marked that zone as my inducement. Most people will be taking their sales from here. Most traders will be taking their sales from here. Let's say here, as we say, because that was, they consider it as now the resistance zone. Most people will be taking their sales from here because they consider it as the resistance zone. But what happens if you keep taking your sale from there? Eventually, price is going to come, sweep you out, take off your stop loss, trigger the main point of interest, and then still continue going in your direction. And the person that entered in will now start complaining, oh, that price came out, took them out, and they still went in their direction. That was because you are liquidity. So that's just it. So this is basically the teaching on inducement and liquidity. I think I will make a teaching on how to write down your trading plan. I don't know for now, but if I would